Good afternoon. Welcome to the TheoTRADE Afternoon video. I'm Blake Young, and today is December 28th, 2023, Thursday, the second to last day of the trading year of 2024. And today we're going to talk about ringing in the new year and ringing out volatility. As you can see, this is the S&P 500. We have a very tiny little body candle here at the top. And the interesting thing that we've been watching as prices continue to march higher is we've seen the bodies get smaller and smaller and smaller and smaller with lighter and lighter and lighter volume. So we really aren't seeing a lot of position taking going into the end of the year. We're more seeing a pause. And the question I have is we're watching this market and we're pushing to new record highs on the second to last trading day of the year, is what is going on with the market? What do we expect? So the market is in a holding pattern. Yes, we're melting higher, but we're melting higher on lighter volume. That would be a good argument that it is retail traders and not institutional traders. And if we're watching this, we want to check volatility. So let's go over and look at the VIX. VIX is probably the number one volatility indicator, and the SIBO Market Volatility Index is near and holding at the annual low. 1253, we've gotten as low as 1181, but as you can see, in today's move, that was a move higher in equities, a slight move higher in equities. We've seen that volatility bounced up slightly. So as we stay in this low area, we are continuing to eliminate and reduce risk and volatility. We're not actually adding on risk, and we're not adding on hedges when the volatility stays this low. We're not seeing the market really defend or protect against this bullish position, which is interesting as the market has so little volume in the market today. So if we're not seeing institutional trading, was this volatility spike the institutions positioning, hedging, and stepping to the sidelines, and this fade back down in volatility and the rise in equities, retail traders without institutions pushing or manipulating the market? So let's take a look at the intraday view today. And to do that, we are going to look at the intraday, but I want to look at the last trading week. So here's 5 days, so it's really going all the way back to last Thursday and Friday because of the holidays. And so this is actually a week and a day, but we're going to talk about it from the perspective of 1 week in the internals. So looking at the internals, this is the tick chart, this is advanced decline, this is the volume, delta volume, and we're looking at the price of the S&P. Now, I've got this zoomed into just today's price action so we can focus on today's price action in the S&P 500. We're going to zoom into the 5-minute chart, and from equity open, my equity opens here at 7:30, so it's right here. So as we're watching this move, we're seeing the market really didn't do much. Tiny little bullish move, as we already talked about, and the key here is this tiny move in conjunction with volume today, this tiny move in conjunction with advanced decline, this tiny move in with how we behaved with the tick chart. So as you can see, we kind of have a high of 1,000 ticks and a low of 1,000 ticks, and that seems to be an inflection point or a turning point of the ticks. The trades up, the trades down. So as we zoom in here on today's price action, you can see based on the 15 minutes, we're not really seeing a lot of real directional move. If we go into 5 minutes, you can see that we cross up, we hit 500 and reverse, we hit 500 and negative 500 and climb. And right at this very second, going into the last half hour of trading, we're going slightly negative on the tick chart. But this advanced decline is the big one for me. Remember that the market is made up, when we look at the S&P 500, of 500 stocks. When we watch the Nasdaq, it's 100 stocks generally. As we're watching the advanced decline, the number of advanced issues versus declining issues, starting last Thursday, a week ago, we gapped up, we made lower highs, lower lows, lower highs, lower lows, lower highs, lower lows, lower highs, lower lows, and today's high, zooming in on today's high, the most positive number of advanced issues we had was about 518. We made that as our lower high. We did not get through our low on the open, but as you can see, we are still negative. We've been negative, except for this one. We had one. The close was 1. If you look up there at the close price, we had one positive, net positive issue here, and then we've gone lower and lower and lower. So outside of that first 2 hours of trading, we've continued to have lower positions held. We're continuing with declining issues more than advancing issues. We just barely pushed down to negative 400. We bounced up to negative 230, but this is still more selling issues or more red on the charts than green. as far as the number of stocks that are up for the day versus down. As we look over here, the market is holding up and is roughly at the same price that we were at 7:30. You can see a 0.02 going into this last half hour of trading. We are flat. So what this tells me is that we're flat on the market. We've been liquidating. We were slightly positive. We're now flat, and we've been liquidating, but we've been eliminating positions. We have more declining issues than climbing issues. So instead of rising, we have falling, and yet we're maintaining flat. That means some of the bigger positions that are being held are going to be the larger stocks, and the smaller stocks are being liquidated and sold off, and we're netting out no price change. This is simply clearing out the mess. This is clearing out the noise and clearing out the volatility. Despite the fact that volatility is up slightly, we have just cleared out the noise. Now, I do think that this is what we should expect. I don't think we should expect this tomorrow. I think on the last trading day, all the institutions have probably stepped to the sideline. The last trading day, I don't expect a bunch of institutional traders to be taking long positions or short positions because they've already cleared it out, as we've seen from the advanced decline going from positive to negative, highly positive, creating lower highs and lower lows. And even as we speak, we're crossing back through here, pushing down again. There's some additional selling in the tick charts. There's some additional selling. If we zoom in on the volume here, we sold off and made a new low just a few minutes ago, and we're pushing through that 0% where we've had more directional volume down on the day as we did just a few minutes ago. So again, this seems to be that we're clearing out all the volume, all the volatility, and setting up for the new year. We're not going to likely see a massive sell-off or massive rally going into tomorrow. We're probably going to see a lot of choppy, a lot of random moves. But when we see random moves, or better said, when we see widening volatility moves in price but not rising volatility in hedging, it's just noise. It's the smaller retail traders clearing out the trades. I'm just watching this as it's happening and seeing that we're continuing to put the pressure on as we continue to push back into the negative, back into the negative, back into the negative, and yet we're still almost flat for the day. 0.01, we're down half a tick or half a point for the day on the S&P futures. One way we can look at this is look at the Bollinger Band width that simply measures the volatility, and what it does is compares the 20-day volatility, or the range of 20 days of the Bollinger Band's width compared to a 150-day Bollinger Band width. And so when Bollinger Band widths are getting wider, that blue line is rising, that tells you that we're getting larger moves on the day, but it doesn't necessarily mean volatility is going up. Larger volatility in price does not mean larger volatility in the VIX. As you can see right through here, the Bollinger Bands were getting wider and wider and wider, which told you increasing volatility, but it was also as the market came down and stopped falling, and we were not hedging during that same time frame. As we're looking at this and we're looking at the moves through there, let me get zoomed out so we're actually matching the same time frame. As we're watching through here, the volatility was down near these lows. Now, as we zoom into the last few months, we're going to go from October. Let's go from 1st of October to the end of the year. And we're going to do the same thing on the VIX. Go from October to the first of the year. And normally we'd expect volatility falling to be mirroring or reflecting the opposite, or inverted to price action at ES, which is what we've got. High VIX, and then it starts falling, and equities put in a bottom and climb. As we look at the volatility in price action, you can see we continue to climb, meaning the range of the Bollinger Bands, the daily moves, the new highs, the new lows, the 20-day high and lows, we're getting bigger and bigger and bigger until right here. And that's where we kind of peaked out. We peaked at the highest level right here, November 21st. And since then, you can see price has gone flat and then melted higher. And volatility as far as price action went down, and volatility as far as options and VIX, being the SIBO VIX, and volatility being measured by options, has stayed low, extremely low. So the melting higher that we've got going on through here, and the low volatility in the VIX and the high volatility in price, it is showing you that we're just clearing out the volatility as far as fear and uncertainty, and we're continuing to melt higher regardless of how big the days have been moving. And the last thing we'll look at really quick is just today's option activities going into Thursday as far as getting rid of volatility. As you can see, I've got the SPY up here, and as far as hedging is concerned, our current implied volatility percentile is 1%. What that's telling us is that we are the 1 percentile, in other words, the lowest price as far as options and volatility that we've been at in the last 52 weeks. The 52-week implied volatility high for the S&P 500 was 0.33. The low is 0.123, and that's where we're at. We are at the 1 percentile. And so we're really seeing next to no volatility being priced in. And if you look at the put-call ratio, we're at 1.14, pretty balanced. We're not really seeing a lot of skew. We're seeing roughly the same amount at the bid and the ask. We're not really seeing a lot of volatility and uncertainty. We are balanced. We're balanced, and we have no implied volatility based off the 52-week range. So as we're looking out into January, if we zoom up here and look at the top price action, out into January, there's our 12.21. That is the 1 percentile, which means it is very cheap to buy directional options in the market. Now, what I would say is regardless of the market not hedging and putting volatility or raising the VIX, this tells you that it's so inexpensive, we're at significant lows. If we're going out to the January 19th, we're trading closer and closer to the earnings season and into the first 3 weeks of the new trading year. This is telling us these are very cheap options. Now, you could try to go with the January 11th or 10th and try to get 10 or 11% on. I think that is certainly reasonable to do. But what it's telling you is, again, volatility is so low, the cost to hedge or the cost to take a directional trade is significantly low, and there could be some real opportunity since the market has cleared out all the volatility going into the end of the year, and we have a lot of uncertainty going into January. In fact, I would say that the cost of options are so cheap. Let's go out another strike. And let's put on our delta. Cost of options are so cheap that if we bought one standard deviation out, knowing that we've been slowly getting smaller and smaller, the volatility is all but gone. If we went out to the 474 and bought the 473, you'll notice that would cost you 31 cents for a dollar-wide spread. That would tell you that you could risk $30 to potentially make 70, which is 2.5 times return off your risk, and a probability that is still about 33%. If you think the market is going to potentially reverse in the first 3 weeks of the year, this is a fairly inexpensive trade to take, 2.5 times reward to risk, with the 33% probability of being at max gain. That's what I'm looking for. I'm looking for long positions, potentially bearish long positions, where I can benefit from a directional spike to the downside and very cheap options to be able to trade a long put in that scenario. Well, that's going to do it for me today. Be careful. We'll look forward to seeing you in the new year.